Tesla Shorts Time Daily, episode 428. Hey, good morning. Patrick here in Vancouver, coming to you with Tesla Shorts Time Daily, episode 428. It's Monday, April 6th, 2026. A fresh week, and as usual, there's a lot going on with Tesla worth unpacking. Let's start with some actually good regulatory news. The United States safety regulator has officially closed its investigation into Tesla's Actually Smart Summon feature. This was one of those lingering probes that had been hanging over the company for a while, looking into how the more advanced version of Smart Summon was behaving in real-world situations. After Tesla identified the specific issues the regulator had flagged, they rolled out targeted software updates to a subset of vehicles. Those fixes apparently satisfied the agency because they've now wrapped up the case without any further enforcement action. What matters here is the precedent it sets. For a long time, there's been this fear that every time a regulator looks at a Tesla driver assistance feature, it could force expensive hardware retrofits or lengthy delays. Instead, we're seeing that software can actually address the concerns in a pretty surgical way. That's huge for Tesla's business because it keeps the cost of compliance down and the timeline much shorter. From a customer point of view, it means one of the more fun and genuinely useful features in the Autopilot family can keep evolving without living under a regulatory cloud. It also quietly reinforces something we've seen Tesla argue for years, that their cars are fundamentally software-defined machines. When the hardware is already capable, a lot of the improvement and problem-solving can happen over the air. That's a very different model from traditional automakers, and regulators are slowly starting to get comfortable with it. So yeah, small story on the surface, but it's actually a pretty meaningful win for how Tesla wants to operate going forward. From regulatory relief, let's slide over to the sales picture because it's been another mixed but interesting quarter. Tesla has taken back the global electric vehicle sales crown from BYD in the first quarter of 2026. For a while there, BYD had been sitting in the top spot, especially as they dominated the Chinese market and expanded aggressively into other regions. But shifting demand patterns, particularly outside of China, allowed Tesla to edge ahead again this quarter. On the one hand, it's a nice headline. Being the world's largest EV maker still carries weight with investors and helps the company maintain some pricing discipline. It also reminds people that Tesla's global footprint and brand strength still matter. But the win comes with an asterisk. Tesla's first quarter deliveries still fell short of what most analysts had been forecasting. The miss wasn't catastrophic, but it happened against a backdrop of changing incentives in several key markets, tougher competition, and what feels like uneven consumer sentiment toward EVs in general. This is important context. It shows that even Tesla isn't completely bulletproof when the broader industry hits headwinds. We've seen incentive cuts in Europe, a slower transition in parts of North America, and of course the constant pressure from cheaper alternatives in China. So while reclaiming the top spot is worth acknowledging, it's also a reminder that demand can be lumpy even for the market leader. Tesla will have to keep adjusting to these cycles rather than assuming steady growth forever. That said, there are some genuine bright spots worth highlighting, and South Korea delivered one of the best ones last month. In March, Tesla sold 11,134 vehicles in South Korea. That's more than a 300% jump from the same month the year before. It's the kind of explosive growth that turns heads and gives the company some breathing room in an otherwise mixed global picture. A few things seem to be driving it. South Korea has been steadily building out its charging infrastructure, and the government has kept relatively supportive EV policies in place. On Tesla's side, it looks like they finally got inventory levels right and maybe improved some of the local marketing. The Model Y in particular seems to be hitting the sweet spot for Korean buyers who want a practical yet premium crossover. This kind of regional surge is exactly what Tesla needs right now. It proves that when the product, the timing, and the market conditions line up, demand can still accelerate quickly. It's a data point that keeps the story from feeling entirely negative. Staying on the product side, Tesla has started opening orders for the 6-seat Model Y L variant in parts of Asia. This is the long wheelbase version, basically a stretched Model Y that gives families noticeably more interior space and flexibility. It sits between the regular Model Y and the much more expensive Model X, which makes it an interesting middle ground option in markets where bigger family haulers are popular. The fact they're rolling this out first in Asia makes sense. Many buyers in China and surrounding countries prioritize rear seat comfort and space for extended family. Offering this configuration without forcing people into the pricier Model X could help Tesla capture more of that segment. It'll be interesting to watch the early order numbers because if it does well, we might see this variant show up in other markets too. Sometimes these region specific tweaks end up becoming more broadly relevant than people expect. On the pricing front, Tesla is doing something a bit unusual with its flagship cars. The company is now adding a $15,000 surcharge on top of the listed price for any Model S or Model X that's already sitting in inventory. This only applies to cars that have already been built, not to new custom orders. It seems like a deliberate move to manage demand, protect margins, and discourage people from treating these vehicles like quick flip investments. It makes sense when you think about it. The Model S and X are the halo cars, but they're also lower volume and higher margin. Tesla doesn't want to flood the market with discounts or let speculators game the system. At the same time, it does create an interesting situation for customers. If you're shopping for a flagship Tesla right now and see one on the lot, you're going to pay a noticeable premium compared to ordering one fresh from the factory. It's another example of Tesla trying to be very surgical about how they balance supply, demand, and profitability, rather than just pushing volume at all costs. Here's a story that should make anyone thinking about buying a used Tesla slow down and do their homework. A woman recently purchased a used Tesla, and just 3 days later she was hit with a $16,000 repair bill. The details are still a bit sparse, but it sounds like it was a significant out-of-warranty issue, possibly battery or high voltage related. Stories like this are becoming more common as the used EV market grows and more cars roll out of their original warranty periods. The bigger point isn't to scare people away from used Teslas. There are still plenty of good deals out there, but it is a very real reminder that electric vehicles, even Teslas, aren't immune to expensive repairs once they're no longer covered. Battery health checks, service history, and understanding what's covered under any remaining warranty have never been more important. For the industry as a whole, these experiences will shape how comfortable people feel adopting EVs long term. Tesla's service network is still playing catch up in many places, and that gap becomes especially obvious in the used market. Buyers need to go in with eyes wide open. Shifting over to the autonomy side, there was a pretty visible robo-taxi outage recently that left more than 100 driverless vehicles offline at the same time. Passengers were reportedly stranded in tough traffic situations while the system sorted itself out. These kinds of incidents are exactly what critics point to when they question how ready the technology really is for prime time. It highlights the massive reliability bar that unsupervised autonomy has to clear. When you're running a robo-taxi fleet, you can't have widespread outages that leave customers stuck and frustrated. The community reaction was pretty loud, with a lot of people focusing on the safety implications if backup systems fail at scale. For Tesla, it's another data point in the very long journey toward true unsupervised driving. They've made impressive progress, but events like this show why many observers remain quite cautious about aggressive timelines for widespread deployment. The gap between impressive demos and bulletproof daily service is still significant. An analyst made waves recently by arguing that Tesla's meaningful long-term growth now really depends on successfully rolling out the robo-taxi business. The same forecast sees the company delivering around 1.6 million vehicles this year, which would still represent decent growth, but the analyst believes the real value driver going forward will be the higher margin autonomous ride-hailing service rather than traditional car sales. It's a view that's gaining traction on the street, especially when quarterly delivery numbers show some fluctuation. This narrative shift is important. It moves the conversation away from how many cars did they sell this quarter toward when does the software business start scaling. If Tesla can eventually turn its fleet into a network of revenue-generating robo-taxis, the margins could be dramatically higher than automotive manufacturing. That's the bet a lot of long-term believers are making. But it also puts enormous pressure on Tesla to deliver on the autonomy timeline because the valuation is increasingly being built on that future rather than today's car business. When you step back and look at the whole picture this week, it's a very Tesla mix of progress and friction. The regulatory win on Actually Smart summons shows that software fixes can still satisfy regulators. The South Korea sales numbers prove that demand can explode in the right market with the right execution. The 6-seat Model YL and the inventory pricing moves on S and X show a company that's being quite deliberate about tailoring its product and pricing strategy to different segments. At the same time, the delivery miss, the used car repair horror story, and the robo-taxi outage all remind us that there are still real challenges in both the near term and the longer term. Tesla continues to bet heavily that solving problems at the system level through software and vertical integration will eventually pull them ahead. The installed base of vehicles they're selling today becomes the foundation for the autonomous services they want to offer tomorrow. It's not always a smooth ride, and the macro environment isn't making it any easier. But the company has shown resilience through cycles before. The question now is whether they can keep executing on the current business while making the very difficult technical leaps required for the next one. Before we wrap up, it'll be interesting to see how the market digests all these mixed signals over the next few days. Robo-taxi updates tend to move the stock more than anything else right now, so any incremental progress there will get a lot of attention. That's the latest for today. TSLA closed at $360.59, down 67 cents, or about 0.2%. If you're enjoying the show, a rating or review on Apple Podcasts or Spotify makes a real difference in helping new listeners find us. You can also find us on X at Tesla Shorts Time. I'm Patrick in Vancouver. Thanks for listening, and I'll talk to you tomorrow. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.